One solution paper, key strategic dynamic memorable experiences. Building is valued at over growth of domestic tourism and the boom in business travel have all contributed to this expansion. What makes the strategic shift with superior guest experience? Balance affordability with superior guest experience. Balance between low cost and differentiation strategy. Rather than competing purely on price, many hotel brands now focus on offering value for experience, delivering smart, comfortable, and technology enabled stay at affordable rates. This approach is achieved through lean operating models, digital transformation, and customer centric innovation. It's a strategy that combines cost leadership and that combines cost leadership with different type of variety of services, creating a sustainable competitive advantage. When it comes to governance part, strong internal financial controls makes the backbone of accountability and transparency standards and good corporate governance. Together with the planning and review process and risk management framework, these policies provide the foundation for internal financial control over financial statements. To illustrate how strategy links with performance, many leading firms, companies now measure success through multidimensional performance measurement frameworks or models. Rather than solely based on financial framework, now they are using non-financial models also. Performance evaluation typically covers financial efficiency, which covers cost optimization, profitability, cash flow management, etc. Customer value includes customer satisfaction, repeat business, and brand loyalty. Similarly, operational excellence means service consistency, compliance, and sustainability. People and culture include employee productivity, engagement, and innovation. The balanced approach ensures that cost reduction efforts never compromise service quality, maintaining the dedicated balance essential for sustainable competitive advantage. This sector, however, face ongoing challenges: rising real estate cost, fluctuating demand, regulatory compliances, and aggressive commission often squeezing margins. Yet, low cost differentiation offer a pathway to resilience by focusing on value creation through efficiency, innovation, and customer delight rather than luxury or heavy capital investment. Why I am explaining all this? Because this is the base of strategic decision making in this specific sector. That's why I am giving some background idea of this sector. Okay, at the same time, opportunities continue to grow. Government initiatives promoting tourism and regional connectivity, it means industry is directly affected through the decision taken by the government. Along with the rise of hybrid work, staycations and wellness travels are creating new market segments. Data analytics and digital tools are further empowering strategic decision making, enabling hotels to personalize offering while managing cost effectively. In previous session, we examined sector like fast fashion, tea, FMCG, logistic, etc. This industry offers yet another practical context where cost management, performance measurement, and value creation is very, very important. Today's discussion, we aim to reinforce a central principle: strategic decisions must integrate cost leadership with differentiation. When business align financial prudence with customer value and sustainability, they don't just survive, they thrive. This expresses the true essence of this paper, developing professionals who can conduct strategy with substance and performance with purpose. Similarly, it is also connected with compliances portion. Okay, today's case studies are drawn from Case Study Digest Volume 2. It covers topic like Michael Porter's five forces model, Kano's model, EVA, risk of outsourcing, critical success factor in Ind AS, as well as GST provisions. Together, these cases integrate regulatory, ethical, financial, and strategic perspective, reflecting the multidisciplinary nature of the IBS paper. We are privileged to welcome CA Sujana Balaji, Director of PKF Sridhar and Sanatanam LLP, to today's session. She is a highly respected chartered accountant who has graciously accepted our invitation to share her expertise. Her insights will help you to connect academic learning with practical applications in business and governance. With that, let us commence today's discussion and explore the case in detail. Madam, over to you.
Thank you, sir. Very good evening. So, the sessions that we'll be having today, case studies we'll be discussing will be case study 9 and case study 15 of the case digest 2. So we'll probably start by giving a background of the hospitality sector. In the audit of a hospitality sector, what are the key risks, what are the key controls that you will see, and then we will slowly move into the case study. So I will also have a couple of other questions apart from what is there in the case digest that I'll be discussing with you today. So the first topic that we'll be taking will be case study 9, which is Home in Limited. So with that, I'll just start sharing my screen. Is it visible?
Yes, ma'am.
Okay, perfect, sir. And if you have any questions, you can probably leave it to me in the chat box. And yes, I will get back to you whenever I see it. Thank you. Yes. So when you look at the audit of a hospitality sector, what are the specific risks and challenges when you audit hotels? So one of the key risks would be in revenue recognition, because revenue recognition in hotels is very complex because there are multiple revenue streams. So you have room revenue as a revenue stream, you have food and beverage, you will have spa, you will have laundry, you will have car, car services that you're rendering. So there'll be multiple streams. Apart from this, you will also have some membership revenue. So membership revenue, which could be for a period of time, could be for 12 months, could be for 24 months, could also be, membership to the hotel's group, could be some loyalty programs that they're offering. So it could be multiple such complex revenue streams. So you will have various different controls. You will have different softwares. You will have different timing or revenue recognition. The controls or revenue recognition for each stream of revenue could be very, very different. So if you take room revenue, it will be based on whether the room is occupied. Am I charging the correct rate? If you look at maybe food and beverage, which is another very critical revenue stream, it will be, am I charging the menu rate? Am I giving any discount? So those would be the controls centered around it. So there will also be different softwares that are used. So the property management software could be used for rooms. There could be a separate point of sale software for F&B. So there could be various different software which are used. So you'll also have to look at the integration controls. You will have to look at how they are reconciling the ERP with the software. So those could be very, very key aspects that you will have to see in the audit of a hotel. Apart from this, the timing also becomes very key because like we discussed, there could be some membership revenues, which could be over a period of time. So instead of at a point of time, they could be over a period of time. And also there could be cases where, there could be cut off issues where there could be a guest who's staying during 31st of March. So how will you recognize the revenue? What portion of revenue would you recognize? That is also something that will be very critical. And controls are very, very important in the hospitality sector. So review of controls, internal controls also becomes a very key aspect. And then, so this is on revenue. And apart from revenue, you will have fixed asset and depreciation. So if you look at hotels, before the adoption of Ind AS 116, there could be a hotel which did not adopt Ind AS 116. I mean, which did not create a ROU and lease liability. And there could be a hotel which creates an ROU. So why was Ind AS 116 even implemented? What is the whole purpose behind it? So if you take hotels could be run in various different ways. They could be an owned hotel, or they could be a hotel which is taken on lease. So if there is an owned hotel, what happens in our financial statements? Your PPE would be very significant because the company would have made investment. The company either would have taken a loan, or they would have some internal accruals which they choose to invest in PPE. So you will have a significant portion of the capital being invested in hotel assets. So your PPE in your financial statements would be a very significant sum. So the associated cost would be depreciation, right? And also if you're financing it through debt, you could also have an interest component. So those would be the key expense items and financial statement line items. However, if you take the case in a hotel which is a leased hotel, so what could essentially happen is they could be, it could be various different cases, but let's just say that there's a hotel which is constructed. This person who's constructed a hotel, but they're having some challenges running the hotel. So they could approach a group like maybe ITC or Taj. They could approach one of these groups and they could say, can you please run the hotel for me? Or Hyatt, for example. They could say, can you please run the hotel for me? Which is also possible, where these groups take over and they have management contracts where they will say, yes, operating contracts, where they will operate the hotel for you. So in that case, the expense of the hotel could be, if you look at those cases, it could be that they are doing it. They are only considering the lease expense, the rental expense. So that's why Ind AS 116 becomes very, very important, because that's the one which will make these two different hotels on par. So they could be two. To compare these two hotels, to make them on par, Ind AS 116 becomes very, very critical. And that is why Ind AS 116, one of the key reasons, one of the key sectors which was affected was also the hotel industry, especially over the leased hotels. So it's just a question for you. If somebody is on chat, you can tell me, where do you think EBITDA would be higher? Would be higher in the case of a owned hotel? So assume there is no Ind AS 116. We were under the AS framework. So where would EBITDA be higher? Would it be higher in case Ind AS is adopted? Would you think, in a hotel where it was owned, or do you think it would be higher in a case where it was rented? Any answers? Seeing the chat box. And I can't see anything. So I'm just, okay. So it would essentially be higher in the case where it is owned or leased. So what Ind AS 116 does to you is, if I'm comparing two hotels, one which is owned, one which is leased. In case the owned hotel, the majority of the cost would be depreciation and interest if it's borrowed. Whereas a leased property, you will only have rental expense. So, but when you adopt Ind AS for this second case, what essentially happens is you will create a right of use asset, and you will also create an associated lease liability. So the depreciation on the ROU asset and the interest cost on the lease liability will become the major elements, right? So that's how it will even out. So the fixed asset and depreciation is also very, very key aspect when you're auditing hotels. So because they have substantial investments in PPE, you will have a lot of buildings, a lot of furnishings. So auditors will also have to assess the adequacy of depreciation methods to see whether the right useful life has been used, whether the right costs have been capitalized. So that's also one of the key aspects that you will see in an audit of a hotel. Next one will be project capitalization, where you will assess the appropriateness of capitalizing costs which are associated to significant capital projects. So you will see whether, as per Ind AS 16, can you capitalize a particular cost or not? It could be a general administrative overhead. So in that case, what do you do? So those are aspects that will be very key in a hotel. It's also important to know, you have to see how the company's accounting policy is framed and whether you're aligned with the company's capitalization policy. Another very, very key aspect, that specific risk that you will find, is an impairment testing, because hotels will have to be assessed as separate CGUs. And you will have, so the impairment testing will, the risk is that you may not recognize an impairment loss on a hotel asset. So they could be a change in the market conditions. They could be, much more. So ECR side, you see, becoming very, very competitive. A lot of hotels coming through. So that could pose a challenge. Or you could have the hotel's revenue generating capacity, which itself could pose risks, because the property is outdated, or there's no renovation, or there is no need in that particular market. So there could be various different external factors which could trigger an impairment, and these could pose a significant risk in ensuring you, and your role as an auditor would be ensure that the impairment testing is done, and you ensure that there is no impairment loss which is to be recorded. Here, what you will also have to see is when companies where they will try to give you discounted cash flow projections. In those projections, you will have multiple different factors that come through, which we will discuss in the subsequent sections. We'll see how a company, what are the parameters which are key to a hotel and how they assess it. So, moving. Okay. You will also have inventory management, which becomes very key in a hotel, because you will have restaurants and bars where there'll be significant inventory to manage. So auditors will also have to verify the inventory, assess the controls over revenue, or controls over inventory counts, see whether there's any obsolescence or theft, which is there. Especially with the shelf life of such stock could be very, very low when compared to other industries. So there it also becomes very key to see how does a company account for expired stock, how do they measure. So bars, you will have measurements, right, in ML. So how does that happen? So the inventory management also becomes very key. In inventory, also to understand that in a hotel, you will have a main stores and you will have a circulating stock. So essentially what happens is, I could purchase linen and I could keep it in my main storeroom, in which case it will be considered as inventory. What some hotels choose to do is they choose to consider, so once the linen is issued, or cutlery, crockery, for example, is issued to the rooms, that will become a circulating stock. So how are the controls centered around items which are already issued to the rooms? Or to the kitchens, like cutlery, crockery is issued to the restaurants, or linens are issued to the rooms. How are controls centered around it? Because the main store's controls are relatively simpler. The circulating controls could be something which is more critical that you would have to see. So inventory management again becomes a very, very important aspect for you to see. And then the hotel industry is also very susceptible to a lot of fraud risks, especially teaming and lading. For example, somebody pays an advance, and then that advance is being used to cover some other payment that is used. You understand how teaming and lading works, right? So advance from one person is shown as received from some other person, that money is swindled. So there could be a significant risk of teaming and lading because of multiple different customers, multiple payments, multiple advance payments also. So there could be a very high potential for teaming and lading. So you will also have to consider these risks when you're running your procedures and when you're looking at assessing controls. And also there's also this liquidity risks which would come into play, especially during economic downturn. So when COVID hit, there was a significant challenge on the hotel industry because travel was restricted. So one industry, tourism industry, really suffered. So during such times, we'll also have to look at the liquidity risk. Whether the hotel is able to meet its short-term obligation could also be something that is very, very critical. Okay, so now we'll look at the key metrics which we'll use for analysis in the hotel hospitality space. So you will have the aggregate room revenue, which is a key metric to calculate the average price at which the rooms are sold in a given period. So what is the rate at which I'm selling a room? What is the average price at which I'm selling a room in a given period? So it is calculated by dividing the total room revenue by the number of rooms sold. So if I've generated 100 rupees of revenue for 10 rooms, the average room is 10 rupees, would be the ARR. Similar to this is while this is for rooms, we will have something very similar for food and beverages, which is the average price per cover, which is again in the restaurant industry, what you will use is the average price which is generated per customer or per table. So this would be the average price per customer or per table. So this will help the restaurant to see what is the average spending by their guest. So what is the general cost? So how should they price buffet? So this becomes a very, very key metric. Next is the occupancy rate, which is a percentage of available rooms that are occupied by guests during a specific period of time. So what are the number of rooms that are occupied at any given period of time? vis-a-vis the total rooms that are available to me. So they say there's a room with 100 keys, and total occupancy over the month is say so much 60,000. So 60,000 divided by 100 into 30 would give me, that is not possible, 6,000. So that will give you 6,000 by 30,000 would give you the occupancy rate. Look at the cost per cover. The cost per cover is a metric which is used to evaluate the cost efficiency of the hotel's F&B business. So what it essentially means is you will have what is the cost that I'm incurring per F&B cover or per customer. What is the cost that I'm incurring? So that will show you what is the margin that you make on your F&B revenues. So that also becomes a very key factor. Next is the revenue per available room, which is very similar, which is ARR into occupancy, which is nothing but what is my revenue per available room. This also becomes a very key factor where you will use this metric to compare how I am performing, how a particular hotel is performing when compared to the industry. So RevPAR is also a very, very key metric. So just a second. What is the importance of analytical procedures in an audit of a hotel? So revenue verification. So why is analytics important when I do work? When I do an audit of a hotel. So AR and APC are key indicators of the hotel's revenue streams, and they will let you know, what are the total actual guest spendings, if there are any discrepancies, how has my ARR moved, so it also helps you to see, ARR, APC, occupancy. If I do a summation, am I getting the total revenue? Does it match? Does it indicate any potential? So therefore, for revenue verification becomes a very, very key metric. It will also help you essentially, very similar to the above, it will help you detect any irregularities. So it will help you compare benchmarks over a period of time or against industry or against a peer group in the same, another hotel in the same group. How is it faring versus how is this hotel faring? Does it look like anything? Is it regular? It will also help you to attract and retain gets as favorable points when you compare and see how the industry average is performing against you. And deviation from the norms will also raise flags. So am I giving a lot of discounts? Am I charging too much? So this will also help you identify any such deviations. And also an early warning sign. If you see any declining trend in ARR, if you see declining trend, it means that I'm trying to reduce my revenue in order to get more occupancy, which means that the hotel is struggling. And also a decreasing trend in RevPAR also indicate that there's some underlying issues with the hotel itself. There could be, something wrong with the pricing strategy or the market demand or the hotel operations itself. Maybe it could be that the hotel is not very clean or neat, so people don't prefer the hotel. So it will also help you give early warning signals. And will also help you analyze expenses. When you look at, example, cost per cover, it will help you understand how is the cost per cover, what is the total revenue that I'm generating per customer or per cover? What is the cost? What is the margin that I'm making? Is it sufficient to cover the overheads? Would be a very, very important analysis for restaurants to do. And should I increase my revenue? Should I decrease my cost? So where should the focus be? So there it becomes very, very important metric. That's why analytics tools very, very important. Just a second. Okay, so with this said, I think we will quickly jump into the first case study that we have for the day, which is Home Inn Limited. So yes, what we'll probably do is we will read the case study together. Then I will give you some time to read through the question. And then we will solve the questions together. If you have any questions, of course, you can reach out to me on chat. So case study 9, Home Inn Limited is a well-established company that runs chains of hotels and resorts across different locations in India. So Home Inn Budget Hotels, the hotel operates as budget hotels and operate under the brand Home Inn Budget. It provides accommodation for cost-conscious travelers visiting the city for a short stay, lasting a day or two. So their target segment is cost-conscious travelers who are visiting the city for a couple of days. Typically, a room in Home Inn Budget hotels would provide comfortable beds, high-speed internet, air conditioning facility, coffee machine, fridge, and free television service. And food service based on a limited menu. So they only have a limited menu, which is provided on premise. It has few conference rooms that provide space for guests to hold business meetings. This saves them time otherwise wasted in traveling in congested city routes. The hotel provides free shuttle service to and from the airport specific times during the day. So they provide free shuttle service. Proximity to the airport, the free shuttle service and convenience of conducting work at the conference have been marketed to attract guests to stay here. The guests also comprise of people who are in transit between airports. Also, when there are long duration delays in flight operations due to which passengers need to be provided overnight accommodation, few airline operators host their guests here. So airlines also, if there are long duration delays, the airline operators choose to accommodate their guests here. Like all other guests, these airline operators also interested in this homeland budget for their location and the low cost rental. In all, Women Limited has 15 hotel properties spread across 15 cities. All of them function under the Women Budget brand, catering to cost-conscious travelers. In all these establishments, since the location of the hotel is near the city airport, the real estate cost, both for ownership and rental, is very, very high. Hence, instead of having an in-house establishment for cleaning and food service, companies outsource these services to specialized vendors. Instead of having an in-house establishment for cleaning and food service, the companies outsource these services to vendors. So what it basically means is, for example, it could be that housekeeping staff are outsourced. It could mean that laundry services are outsourced. So this will reduce, they're saying this will reduce the additional space requirement needed to maintain these facilities to provide these services. So what they're saying is example, they could be, it could be that because the rental cost is very high, they're not able to have a dedicated laundry room, because of which they aggregate their laundry and then send it outside and receive it back. So they don't have to take the real estate cost. They don't have to have the additional space. So it is outsourced. This will also help them keeping the cost of operations within control. So it could be that maybe not everybody needs laundry because people are only visiting for a couple of days. But however, if somebody needs it, they still provide the facility, but they also keep their operational cost very low, because in this case, it's only a variable cost. Whereas if they choose to do it in-house, there could be some fixed cost components. So that is why this becomes very key for them to have their cost of operation within control. Since the hotel property is in the city, there is ample availability of vendors providing the service. So we also saw that it's near the airports within the city. So you will have ample availability of vendors for the service. And cleaning services includes the cleaning of kitchen, crockery, bedding, laundering, and housekeeping of premises. So these are the variety of services which are outsourced. Similarly, the entire set of activities related to preparation of food has also been outsourced. So vendor services has been satisfactory, barring few instances where guests have complained about the unhygienic room or non-palatable food service. However, due to high guest volume and quick turnaround of guests due to short stay periods, we saw that people only stay for a couple of days. This has never been a hindrance to the business. This business model has been profitable since establishment. Women Limited has a sizable market share in the segment. Competition has increased in the recent past. Price wars have put a pressure on profit margins of budget hotel segment. Room rates are increasingly being determined by the prevailing market rates in respective locations. So they've said that room rates are increasingly dynamic, have become very, very dynamic, and are depend on demand and supply. So they'll have to adopt more of a dynamic pricing than having a very fixed room tariff rate. Okay, so this is the home in budget. Now look, they're talking about a different brand itself. They're talking about the home in comfort resort. So the management plans to continue to operate the budget hotel to maintain its market presence. So they don't want to stop this. They want to continue operating the budget hotels, but they want to cater to a different target segment. At the same time, they also want to sustain business in the long term. The management of Women Limited has forayed into developing properties for luxury resorts under a separate brand called Women Comfort. So they have a completely new brand which is called Women Comfort. And target guest segments are vacationing tourists. So target segment there with business tourists who came to town for a couple of days, who are budget conscious travelers. However, the target segment here are vacationing tourists who are interested in having a laid back time in a scenic place. So there you saw this is from the city side, it was near the airport. However, the target segment here could be very, very different because they want a more laid back time in a very scenic place. The guest would not mind paying premium for availing good quality service. Maintaining cleanliness of the premise and food service are critical activities in the operation of luxury hotels. Unlike cities, the location of these resorts in the more sparsely populated locations. So it could be near a beach, it could be in a very deserted mountain. So these could be very sparsely populated areas, and you may not be able to find as many vendors who are providing cleaning and food services like who are providing in the city. So there you also have a challenge that you may not have access to a lot of different vendors like you do in the case of budget hotels. Customer satisfaction is also paramount to sustain and grow the business in the luxury resort segment. There, keeping the cost under control was the key. Here, customer satisfaction is very, very key. But the ability to post reviews online on booking portals, any negative reviews, whether justified or not, can reach very easily to a large number of potential guests. So when they read these reviews, they may not be inclined to come to these hotels because they're very particular about having a good time at a very good place. So they may not, such negative comments could negatively impact future businesses. So they have to be very, very conscious about this. So with this said, Homan Limited is developing a home and comfort property in Goa. They have also given you some metrics on what are the total different costs. So we'll come back to this when you're answering the question, but I'll just read it out to you. Construction involves several key expenditures essential for acquiring land, preparing the site, procuring materials, labor costs, safety measures, and other associated expenses. Company has invested 15 crores in land acquisition. 2 crores for site preparation could be as simple as land leveling and things like that, fencing and things like that, site preparing the site for construction, foundation and things like that. Dismantling of existing structures could also be, could be some structures there. So you have to dismantle it to construct in order to construct. So you have an additional 2 crores expenditure. And the cost of direct materials, which is could be cement, bricks, could be 8 crores. Labor cost could be 3 crores. You have 20 lakhs paid during a labor strike. Structural safety testing has been conducted at 0.5 crores. So you have structural testing. This is not feasibility. This is structural safety testing, which is very, very key. They could also be, you could have market viability studies, economic viability. Should I have a property in Goa in this particular space? So that could be different, but what they are saying is structural safety. And legal and architectural consultants fees stand at 1.5 crores. And then you also have 0.1 crores, which has been paid for relocating the resort manager from Mangalore to Goa. Because it's a new property, you need a resort manager. You have decided to move a person from Mangalore at a cost of 10 lakhs. And you also have 0.5 crores, which has been allocated for administrative and overhead costs. These expenses collectively contribute to successful development of home and comfort resort, ensuring quality construction and operational efficiency. So I think all these costs are very, very incidental to the construction, is what the management is saying. The property has been acquired from an unrelated party at arm's length transaction value. 5 of the 6 directors were present at the board meeting to consider and pass the resolution to acquire the property. Okay. The operations at the Goa resort started as per the expected timeline, and it's in the 3rd year of operation. The recent management meeting, key financial data was reviewed. The resort reported a net operating profit before interest and tax of 5 crores with a depreciation expense of 3 crores. The change in working capital was 2 crores, while capital expenditure was 5 crores. The total invested capital in the resort was 20 crores with a weighted average cost of capital of 8% and a tax rate of 30%. Of course, when you're doing this question, we'll probably come back here, but this, you can probably note this down. Homan is a renowned hospitality chain with a nationwide presence, providing top-tier accommodation in key metropolitan cities. The commitment to providing a seamless and comfortable stay experience, Homan operates a diverse portfolio of hotels that cater both to business and leisure travelers. So they have 2 different target segments. One of the key offerings in the Homan is its combined stay, which allows guests to book accommodations in multiple locations under a single consolidated plan. This package is particularly beneficial for travelers with multi-city itineraries, such as business professionals, tourists, corporate delegations. By bundling these stays in different states, bundling stays across hotels in different states, they provide a convenience, cost-effectiveness, and hassle-free booking experience. So they've also given you a case of Mr. Vikash, a business from Mumbai who undertakes a business trips and chooses Homan for his accommodation. They charge a consolidated sum of 60,000 to Mr. Vikas for a stay at 2 hotels in Delhi and Jaipur, where in the Delhi stay was for 4 nights and the Jaipur stay was for 2 nights. So with this background, we'll quickly start going to the questions. So what we'll do is I'll read out the question. I'll give you some time to process it. And what I would like to do is, if you've attended my sessions earlier, I'd like to go back to the section, the index. I'd like to go back to the standard or the law to see how it is worded, and then come back to the answer, which is what I will be doing in the session also. So the first question that we have is for the Homan budget properties. Identify the listed activities to the 5 primary activities of Michael Porter's value chain model. So they are saying they've given you 5 activities and they're giving you 5 different primary activities as per the value chain model. The storing of, so I'll just read it out and then I'll tell you what Michael Porter's value chain model really is. And then you can probably take a shot at it. I'll give you 2 minutes to go through and then we will discuss the answer. So the activities that's given is storing vendor delivered freshly laundered crockery, bedding, and laundry for future use as per guest requirements. ensuring cleanliness and safety of rooms, working order facilities like TV and internet, coffee machines. The review of food items to remove the old past expiry to ensure customer satisfaction and safety. Free shuttle service to attract guests to stay at the hotel, and front desk activities handling complaints. The primary value activity as per the value chain, we would have operations, marketing and sales, inbound logistics, service, and outbound logistics. So if we can quickly go to the workings. So what Michael Porter's value chain model does is it analyzes the company's internal activities to understand cost, to identify a competitive advantage. Okay, so what are where are my primarily costs coming from, and what is my competitive advantage? So this was introduced in his book Competitive Advantage in 1985 to explain how businesses create value to customers through a series of activities. So each activity adds value. That's why it's a value chain model. So each activity adds value to the product or service. And by analyzing these, a company can understand what are its primary cost drivers, what are its sources of differentiation, and what are the areas for efficiency. So this is what his value chain model looks like. So I'll probably give you 1 minute. You can 1 or 2 minutes, and you can just go through it. And once you're done, we will discuss the time. 7-9. I'll give you a minute. Can you hold the answer? So if you see, so what is inbound logistics? Inbound logistics is more about receiving, storing, handling of raw materials or inputs. That is what inbound logistics means. Operations is transforming these inputs into final products or services. Outbound logistics is delivering these to the customers. Marketing and sales would be activities to attract and retain customers. And service would be post-sale, where you will have after-sale services that enhance or maintain the product value. So as far as women is concerned, a storage of clean linens, food supplies and beverages would be inbound logistics. So that's more focused on how do I receive, how do I store, how do I handle these raw materials or these inputs. And operations would be transforming the inputs into final products. So housekeeping, room preparation, maintenance that make the room get ready for guests could be operations. Outbound logistics would be checkout process, your billing process, coordination with the travel desk, or it could even be removing food which is past the expiry date, which is critical on delivering the final product to the customer. And marketing and sales would be activities to attract and retain the customers. So more focused on how do I advertise, how do I do online booking, do I do partnerships, loyalty programs, do I do any promotional offers, do I offer free shuttle services to customers for pick up and drop. So those could be marketing and sales. And after sales services would be how do I handle guest complaints, how do I collect feedback, right? So in our case, storing of vendor delivered freshly laundered crockery, bedding would be inbound logistics. How ensuring clean and safety rooms, working order of TVs, internet, coffee machines would be operations. The review of food items would be outbound logistics. The free shuttle would be to marketing and sales, which we discussed, saying you have activities that will attract and retain customers. And the last is front desk activities, handling complaints and customer support, which would of course be service. If somebody's asked a question. Yes. Perfect. Okay. Thank you. Okay, so we'll go to the next question. As regards homeland comfort in resorts, the parameters relating to high quality, cleanliness, and food service can be classified under which attribute of the Kano model? So I'm sure you know that the Kano model, like we see, perfect. Yeah, that's right. Thank you, Sanjay. You're right. So, Kano model will have five different thresholds, which is the five different attributes. The first is a threshold attribute, which is something which is very, very, basic, necessary. For example, we discussed, I think earlier that a mobile phone in a working condition would be a threshold attribute. A performance would be the quality of the battery. Delight factor would be a fantastic battery which lasts for 2 days. Would be a delight factor, and you will also have indifferent factor. Not very particular about this. Could be an indifferent factor, and then reverse attribute could be having this, for example, having a curved display or having a foldable model could be something that I'm not particularly interested in, so that could be a reverse attribute. So in case for hotel, the high quality cleanliness and food service being is a very, very primary requirement of a hotel, so that becomes a very, very threshold attribute. So it's something very basic that the hotel is supposed to do. So especially if this is not the budget hotel, this is a comfort hotel. So these comfort hotel, high quality cleanliness and food service are a threshold attribute, because they are charging the customers very, very high for it, and the customers also demand a very high quality, very clean environment and food service. So that becomes threshold attributes as far as the home and comfort hotels are concerned. Right? Okay. Next question would be, which of the following statements is true as regard to the resolution taken at the board meeting to acquire a property in Goa? Whether all five directors. So I've reframed the question a little. So I've decided to analyze it in a slightly different way. So when you look at the powers of the board, so what you have to do, how I approach this question is, can the board take this resolution? If it does, what is the quorum, and how will I pass it in a circular resolution? So these are the three things that we have to analyze essentially. So when you look at the powers of the board, can the board acquire a new hotel? Is it empowered to? So the board has the power to take over a company or acquiring a controlling or substantial stake in another company. So the board is empowered to do, to have section 179, which empowers the board to do this. Right? And then next thing that you will have to see is what is the quorum in this particular meeting. So the quorum of this meeting would be 1/3 of the total strength of two directors, which is higher. So we have quorum in this particular board meeting. Yes, so we have quorum. 174 is complied. And then the next thing that we go is passing of resolution by circulation. So it says the resolution has to be approved by majority of the directors and members who are entitled to vote in the resolution. Which case, yes, they have majority of the board has approved this, and therefore, yes, the acquisition is valid under Companies Act. That's how I will approach the question, saying when all five directors for Homan Limited attend the meeting concerned to the acquisition of the property, the acquisition is valid under Companies Act. Right? The next would be the economic value added. So the economic value added, I'll quickly go and show you the relevance section. Yes, I will give you 1 minute. You can probably work it out, and then we will discuss the answer. Okay, so let me quickly answer. So economic value added is NOPAT minus WACC into capital employed. So that said, just a second. Sir, you have a NOPAT, which they've said is 5 crores, and they've given you a tax rate of 30%. So you have a tax. So the net operating profit after tax would be 3.5 crores. So they've given you net profit before tax, and they've not said anything about interest. So they have said tax is 30% of 5 crores, 30% is 1.5 crores. So the net operating profit after tax will be 3.5 crores. The capital charge is back into invested capital, which is 20 crores to 8%, which is 1.6 crores. So economic value added is 3.5 crores less 1.6 crores, which is 1.9 crores. So the answer is D. Not covered yet by me. You said you need more time, or Sanjay? You're saying you need more time? Okay. Is it clear? Do you need any more clarification? Okay, thank you. Okay, so we'll go to the next question, the fifth question. Well, okay. Which of the following statements would most likely be true? Can I vote? So, which of the following statement would most likely be true? Homin Limited should outsource all its cleaning and food service operations in all its properties, ignoring the risk of outsourcing. Homin Limited should outsource its cleaning and food in all its properties, ignoring the risk of outsourcing, if the cost of outsourcing is less than the cost of providing the service in-house. This is because economic value added to the company would positively be impacted despite the risk of outsourcing. The risk is moderate and within the company's risk appetite as assessed by the management. Would this be true? Homan makes an absolute comparison of EVA of one property with that of another, irrespective of the difference in scale of the respective operations. Would that be true? Homan Limited should reconsider the feasibility of operating properties irrespective of the EVA. Homan, as a measure, takes into account the current purchasing power and adjusts for inflationary trends. Hence, it's a more appropriate measure to track as compared to book profit. I'll probably give you a minute. Okay. Yes. So the answer is A. And I will quickly go to the answer and show you. So in this particular case, they're saying that they should consider outsourcing all. What is option A? You want to see what is option A? I'm so sorry. So option A is Homin Limited should outsource all its cleaning and food service operations in all of its properties, ignoring the risk of outsourcing. If the cost of outsourcing is less than the cost of providing the service in-house, they're saying you should outsource it. This is because the economic value added of the company would be positively impacted despite the risk of outsourcing. And they're saying this risk is moderate in the company's risk appetite. It's within the company's risk appetite. And they're saying that they'll be able to manage this risk. So they're saying every Homin Limited property should do this. They should outsource because okay, perfect. So this would be the right answer because any property which has a negative EVA would mean that the property is not making enough profit to cover its capital cost. The WACC. Therefore, it's very important that they reassess it. So this would be something that is most likely to be true because negative EVA means that the property is not sufficient to cover the cost of your capital. Therefore, this becomes a very, then this is most likely to be true. Right? Okay. So we will then come to the descriptive questions. So 6A would be explain the risks of outsourcing cleaning and food services of the home and comfort luxury products properties. So they're saying what are the risks of outsourcing cleaning and food services for the comfort group of hotels? What would be your suggestion if the management of Homin Limited determines that the guest experience, which is primarily influenced by the cleanliness and the food service, is a very important critical success factor? So what would be your suggestion in this case? How is it different from outsourcing cleaning and food services to the home and budget when compared to the home and comfort resorts? And what benefit does Homin Limited derive by operating different properties under two separate brands? So these are the questions. I will again give you 2 minutes, 7:22. I'll probably give you 3 minutes. You can go through this and we will discuss the answer in 3 minutes. Yep, we will go to solution. So this is something that we already discussed earlier. They have this very different branding between the budget hotels and comfort hotels. And they're also deliberately choosing to keep the outsourcing only as part of the budget hotels and not for the comfort hotels, because the target segment itself in these two segments is very, very different. In case of the first case, we discussed that they're budget conscious, they are staying for only a very short period of time. So they only want clean rooms, they want hotels which are there in the city, they don't want to travel a lot. They would prefer, complimentary shuttle service between airports. So the target segment that you're having is more of business travelers who are coming for a couple of days, not particularly worried about the look and feel and the experience. Whereas the comfort hotels is a very different segment where they're coming more for the experience. So cleanliness and food service becomes very, very important. You also saw that the menu offerings in the budget hotels are very, very lean when compared to the luxury hotels, where that also becomes a very, very key success factor. So the risks of outsourcing the food and cleaning service in a luxury hotel is that the target guests are travelers on leisure. Primary feature would be good quality of service. They're coming for the good quality of service, maintaining cleanliness, premises, food service. For example, a nicely landscaped garden would be something very, very important for these guests when compared to the business travelers. Therefore, customer satisfaction in these metrics is paramount to sustain and grow the business. So the ability to post reviews online. We also saw that one negative comment could bring down the number of potential guests who would be coming to the hotel. So that also is a very, very key factor for them. This can negatively impact future businesses for them. Therefore, the Home in Comfort brand has to deliver the quality of the service it provides in terms of cleanliness and food to meet the guest expectations. So when I outsource it, I am not in control of this. I am giving this to somebody else. So if I'm going to give this to somebody else, what should I do? Also, what are the risks that I could have, and how do I mitigate this? So outsourcing the service in a well-established vendor is advantageous since the focus can remain on improving guest experience. It may also be a cost advantage in many cases, because we saw that, for example, there are not many laundry in a particular month. Say it's not the season, so I don't have I don't have a lot of laundry, in which case it could be that, the laundry room, the laundry staff are not being optimally used. Whereas if I outsource it, I could be saving on there. So these are the timelines that you should have. I can't have me giving the laundry and giving them after 3 days. So that could be a challenge. So I have to ensure that I have service level agreements which also define the TAT. So they have to also be drawn up. They should also be able to monitor the performance of these vendors. So they should say, if there's a delay, what do I do? If there is laundry which is has been misplaced, which has not been delivered on time. So so how is the performance generally been? Or if there's a quality deficiency, how do I track it? How do I monitor these performance? That also becomes very key in this case. In case of non-delivery of the required level of service, the agreement should provide for means of redressal. So I should ensure now, if you don't do X, Y, Z, what would my redressal be? Would I recover these costs from you? Would I recover any compensation from you? So there could be compensation for any loss in business to immediate termination of service. Could be any of these factors. So this is one of the risks, and this is how you will mitigate it. And the next thing is Homan Limited should ensure that can easily and economically switch between service providers if required. We also saw that the number of vendors who are available in these resorts which are sparsely populated is very, very low. So you may not have access, like in the case of budget hotels, you may not have access to very high quality vendors. So you will have to make do with whoever are the vendors which are available. And you can't even rely on somebody who stays near the city, because transportation cost and time would be very, very significant. So that could also be a challenge. So you have to ensure that you can easily and economically switch between service providers if required. You have to identify alternate vendors who can provide the same level of service as the current ones. You also have to ensure that they are also saying, since there are certain location where the number of vendors providing these services is limited, it increases the risk of outsourcing these services. The other risk of outsourcing could be instances where well-performing vendors could go bankrupt or shut shop. In such cases, the resort operation could be immediately be impacted because such service can no longer be available with these vendors. There's only one laundry shop in that particular space and they decide to close for some reason, then you will not be able to provide laundry services to your customers. So that becomes very, very key. So list of alternate service providers, very important to have a backup in such cases in hotels. So this is the first answer. Let's look at the second question. What would be your suggestions if the management of the hotel determines that guest experience, which is primarily influenced by cleanliness of facilities and food service, is a very important critical success factor? So when the management determines that this guest experience, so you find these hotels that a lot of people try to get surveys from you. So whenever you go to especially star hotels, 5-star hotels, you will have a lot of customer feedback forms that you're required to furnish. And a lot of these times, the big brands will try to keep a part of the hotel's performance management appraisal linked to this grade that they're getting. What is the customer score that they're getting? So it could be a very important factor. So much so the performance incentive itself could be dependent on how clean, how happy are customers. So it could be dependent on that. In many hotels I've seen that they have some kind of metric. Could be a guest satisfaction score, it could be some survey results, it could be anything which feeds into that performance bonus computation model, where one part, maybe 10% the score is dependent on this, could be. So guest experience is very, very important in those kind of hotels, especially these star hotels, these home and comfort brand of hotels. So where the management of home and determines of guest experience primarily influenced by cleanliness, facilities, and food service, a very important CSF. It may choose not to outsource these services to outside vendors because they will not be in control. The quality control issues and poor customer service may wipe out any cost savings which are attributed to lower expense from outsourcing. So what they're saying is, it could be that I save rupees 10,000 a day by outsourcing it. But the loss of business, even if I lose one customer, and where the average spend per customer is say 12,000 rupees, I'm actually losing out. I'm losing 12,000 where I'm trying to save 10,000. So I'm actually losing more than what I'm trying to save. So quality control issues and poor customer service may wipe out any cost savings attributed to lower experience from outsourcing model. So Home and Limited will have to consider developing in-house departments that cater to cleanliness and food service. So you should consider developing in-house facilities, controls over factors such as input materials used, the performance. So what is the detergent that I'm using? What is the how often am I, how quickly am I giving these laundered products at laundry products, and what is my turnaround time? Is there any stain or complaint that I'm receiving? What is the equipment that I'm using? Am I using high grade equipment? How am I ironing these? Training of staff. So how am I training my staff? When I even as much as go for collection, how am I treating my staff? So these could be very, very essential factors that's required for the service quality. Better service enhances guest experience through these critical activities. Compared to outsourcing, this may be a costlier option. This definitely could be a costlier option because there's some fixed cost element that is involved. Whereas in case of outsourcing, primarily only variable. However, since the guests are ready to pay a premium service quality, they should choose higher rates for its resort properties. So they're saying you should not skim, you should not. So it's always a trade-off, right? Do I increase my revenue that I charge from customers and increase my cost at the cost of, if I'm going to increase my cost, I will also have to charge it on to my customers because I cannot be bearing those costs. So it's always a trade-off. Do I keep the rates low, the rates I'm charging low, and quality at a very budget level, or the quality would also be at a very nascent level, or do I increase my quality and also increase the rates? When customers are willing to pay a premium for the service quality, then I should be charging more and also ensuring that it's okay if my cost is a little higher, but that will ensure that the customers are staying with me. So that is always a trade-off that you will have to see in such cases, right? Okay. And the next question would be, how is this risk different from outsourcing and cleaning of food services in the home and budget when compared to the home and resorts? They're saying, how does your target segment react to these types of outsourcing? So difference in outsourcing of home and comfort and home and budget is driven by the difference in focus and target customers of that respective business model. My focus segment in the first case is more of budget travelers. The home and budget hotels are budget travelers who are conscious about price, whereas the comfort segments are more leisure travelers. So the target segment itself is very different. The home and budget focuses on providing value for money to the cost conscious short stay guests. We also saw that the stay is a couple of days only, whereas the comfort is more on customer experience or quality of service. So the home and budget cost is, the real estate cost is very high both for ownership and rental, and the cleaning and food service has to be outsourced because I cannot afford to have them in force. It could be that I cannot afford to have them in outsourced. Not just that, also the fixed cost component, everything plays into having requiring that these services be outsourced. This helps them keep their cost of operations low, which is a very critical factor for the model of home and budget. The low cost of operations is a very key factor, critical success factor for home and budget. So the dissatisfaction among customers it could be within limits. Saying it could be that out of 100 customers, one customer is not satisfied. That is okay because that could be within the risk appetite. There could be some risk tolerance limits that they could have, and this would not negatively impact their business. People are going to come, even if if there's out of 100 reviews, one review is bad. People are not really going to be bothered about all that. So for a home and budget, the critical success factor is low cost of operation to guests in order to offer guests at a reasonable rates. That is a critical success factor. Whereas if you look at CSF in home and comfort, there it's most of the guest experience, the cleanliness facilities, the food service. These become very, very core. And the risks of outsourcing that we already saw is very, very high. We saw in the earlier answer that the risk of outsourcing very, very high. Therefore, you'll have to consider whether you will have to outsource the activities at all. And the pricing will also directly reflect these costs. So in budget hotels, I will be able to provide more cheaper rates because I'm outsourcing it. Whereas in case of the luxury hotels, the cost will be a little higher. And the charge will also be a little higher to the customers, right? Then the last question in this would be, what benefit does Homan derive by operating different properties under two different brands? Very, very clear that they're catering to two different target segments. They're catering to, so that they have this differentiation in brand because if they have Homan as a budget, Homan itself without having the budget and comfort, people, conscious, they will not be able to identify. No target segment will be able to identify. So if you look at, say, example, the Taj group of hotels, they have Taj Vimanta, they have Taj Gateway, they have Ginger hotels, they have Taj hotels, they have Taj Palace hotels. So you have many different brands which the Taj group itself operates. So when Ginger hotels would be more of a budget, whereas if you look at the Taj brand or you look at the Palace hotels, you know that you're looking for something which is very, very luxurious. So that is why this is very important because people associate. You have to give people. You have to ensure that your branding is in such a way that you have separate identifications. You don't muddle up into, so customers don't get confused. Customers know what to expect from Human. They know that they can expect best cost, and they can also expect decent stay. Whereas they can expect hotels which are inside the city where travel time is low. They can expect free shuttle services from the airports. Whereas in Home and Comfort, they can expect that they know that they're going to pay a lot, but they know that there's going to be the comfort. There's going to be a very nice location. There's going to be very, very, very hospitable staff around them. So based on these expectations, customer appeal can be very, very distinct. The target customer that you're attracting could be very, very different. So even if you are traveling, when you're traveling on business, you would prefer home and budget, whereas when you're traveling for vacation, you could prefer home and comfort. So by operating different properties under the home and budget or the comfort brand, they have created a brand strategy that can effectively communicate the product and service offerings to potential customers, only for the target customers, instead of confusing your branding by doing everything under the same brand where customers don't know, do they expect, can they expect lower cost? Should they expect high level of cleanliness? So they don't even know what to expect. Instead of that, you are creating very, very, very different brand in itself. So ensure that customer expectations can be effectively met. So this is on the last question. And the seventh question would be, identify the cost to be capitalized under India's 16 PP for home and comfort resort being developed in Goa. So I'll quickly show you the question. Just a second. Yes. So I will give you 2 minutes, 7:38. So I'll give you 2 minutes, 7 until 7:40. You can see, you can tell me what are the costs that are supposed to be capitalized, and then we will quickly go through it for the answer. Perfect. Yes, that's right, Sanjay. Great. Okay. And then we'll probably, so what I would like to do again is go back and read what AS 16 says, India 16 says. So they're saying examples of, so para 19 says examples of costs that are not cost of an item of PPE are cost of opening a new facility, cost of introducing a new product, which is including the cost of advertising and promotional activities, cost of conducting business in a new location or a new class of customers, including the cost of staff training and administrative and general overhead costs. So these are costs which, see, I hope you can see it now. So these are costs which cannot be capitalized. So recognition of costs in the carrying amount of an item of PPE ceases when the item is in the location and condition necessary for it to be capable of operating in a manner intended by the management. These costs incurred in using or redeploying an item are not included in the carrying amount of that item. Costs incurred in using or redeploying an item are not included in the carrying item of that item. For example, the following costs are not included. Example, cost incurred while an item is capable of being operating in a manner intended by the management, yet to be brought into use or operated as less than full capacity, initial operating losses, or cost of relocating or reorganizing an entity's operations. Right? So with this, yes, true. You're right. Absolutely, yes. So we will quickly, so Sanjay has correctly pointed it out. We will quickly go to the solution. Just a second. So if you see here, there were various different costs which was incurred, but there was one cost which was incurred during a labor strike, right? And there was one cost of relocating a manager from one hotel to another hotel. So we discussed that para 20C of PT says the capitalization sees of an item is in the location and condition necessary for it to be capable of operating in a manner intended, and the redeployment of an item should not be included in the carrying cost. Therefore, the cost of relocating or reorganizing a company's staff should not be included in the cost. Therefore, the relocation expenses of the hotel manager from Mangalore to Goa and the administrative general overhead costs should not be considered when you are taking the when you're capitalizing under Ind AS 60. And also, direct labor costs which are incurred during a strike is not a directly attributable cost. So you can see very well here that I probably did not keep that extract, but you should only capitalize costs which are directly attributable to the amount that is being capitalized. And because this particular cost of labor strike is not a direct cost which is attributable, that cost will also not be considered. So the three items that will not be considered, just a second, I'm just quickly going up, would be the 20 lakh that you've paid to the labor strike, and you will also not consider the cost which is spent on relocating the resort manager from the Mangalore to the Goa hotel, because he is already there in the Goa hotel. So the relocation cost is not necessary for you at this. I mean, it's only relocation cost, and India specifically says that cost cannot be included. And similarly, they have also seen that administrative and general overhead costs cannot be considered, even though you can say that my corporate finance team is looking at this. The overhead cost cannot be allocated, and therefore that is why these three items have to be excluded. So if you exclude these three particular items, you will have 29.8 crores which is being capitalized under Ind AS 60. Right? Any questions? Let me know. And the last question in this particular segment is determine the place of supply and value of supply in respect of accommodation provided to Mr. Vikas under the GST provisions. So it's very, very straightforward. So let me quickly go to Section 12.3 of the IGST Act, which says the place of supply of services would be in case of lodging accommodation by a hotel or an inn or a guest house or a homestay or a club or a campsite or by whatever name it is called, including a houseboat or any other vessel, would be location at which the immovable property or the boat is located. Yes, absolutely, you're right. Yes, so that's what 12.3 of the IGST Act says. It will be the location of the immovable property, wherever the immovable property is located. So there were two locations. One is in Delhi and one is in Jaipur. So you will have two in the ratio of 4:2. Again, I'll just go with the answer. So 12.3, you have the place of supply is the place in which the immovable property is located or is intended to be located. And therefore, in case of immovable property, this is not there. In case of immovable property attributable to different states where immovable is located, value shall be proportionate to the ratio of number of nights stayed in each such property. Therefore, the place would be both Delhi and Rajasthan, and in the ratio of 4:2. So totally 60. Stayed 4 nights is to 2 nights. So 40,000 is to 20,000. So that is the place and time of place of supply, and how you will segregate it between these two. Right? Any questions? Okay, nothing. I'm thinking that there's no question so far. So it's 7:45, 7:46 right now. We will have a short break of 15 minutes, and then we will reconvene and we will go through the Sartaj Hotels Limited. There's also an additional descriptive question that I have in this context, and I also want to discuss some car-related aspects with you, which we'll probably do in the next half. two more things that I wanted to discuss with you. Am I audible?
Yes, ma'am.
Perfect. Yes, thank you. Okay, so this is a case of Sartaj Hotels Limited. The hospitality industry in a dynamic and multifaceted sector that plays a pivotal role in the global economy, encompassing a wide range of services, including lodging, F&B, tourism, and event management. Known for its emphasis on customer service and experience, the industry thrives on creating memorable and personalized experience for its guests, whether through luxurious accommodations, exceptional dining, or unique recreational offerings. Despite challenges like high job mobility and evolving customer preferences, the hospitality industry continues to innovate through technology, sustainability practices, and ESG. Sartaj Hotels Limited, country's largest listed hospitality company, continues to demonstrate industry-leading growth with consistency and conviction. This is reflected in its exceptional financial and non-financial performance, including portfolio expansion, scaling of new businesses. The company achieved this while aligning with its sustainability commitment and ESG initiative. These attributes accentuate its remarkable journey to create value to all stakeholders. The Sartaj consistently stems from its convictions and values and commitments to excellence. With over 120 years of leadership in the industry, they're renowned for its exclusive properties, flawless service, and distinctive brands. So we already discussed about brand differentiation earlier. These all embodying cherished notion of Sartajness create unforgettable experience for guests. The company's deeply rooted values and rich legacy provides the confidence to reimagine the future, enabling them to grow from an ecosystem with greater speed, synergy, and success, bringing delight to the customers and driving enhancing value for all stakeholders. The company has evolved from a branded house into a house of brands that offer multiple portfolios, luxury, upscale, lean segments, budget stays. The hospitality ecosystem is further strengthened by innovation and service excellence. Hotel food service has historically been an integral part of the hotel business. The food service provides guests with food for consumption, business-related functions, entertainment, and celebration events. And some hotel foods act as an attraction of its own. Like you've seen that they're very, very popular, like the milk cake, very, very iconic items that they have. So food service production is primarily based on fresh produce. The perishable nature poses the challenge for hotels, which is complicated by the presence of multiple food outlets. So you see that there are multiple different outlets. You have a multi-cuisine, you have a coffee shop, you have a specialty restaurant. So you'll have multiple different hotels inside or restaurants inside a hotel. So you'll have multiple different supply chain activities also. Hotel food is also not designed to be stored for extended periods. So once prepared, is expected to be consumed immediately. So the production of food has to be very, very fresh. It has to be dependent on the type of food service offered by the individual hotels. In terms of forcing, there are two main groups of food production, which is push and pull. So very, very important. So push production means what has not been paid for in advance. So these are where, customers come and order from restaurants, a bar or guest rooms or any outlets where they can be ordered on demand. The number of outlets depends. The type of food that the people order will be different. So this is some demand that you can't really, you will have to predict only. Whereas pull refers to functions, conferences, banquet events, which have already been reserved in advance. So you know that you have 1,500 people coming in, and this is the menu that you will have to cater for these people. So payments are also received in advance. So you will know what are the attendees, what is the type of food, what's the venue, everything you will know in advance. So that is pull production. So when it comes to food sourcing, push and pull have very different conditions. So push production presents a greater challenge because there are demand uncertainties. You don't know what customers are going to order. So of course, buffet you can predict to some extent. There again, you can't predict how many people will take the buffet. Similarly, if it's a la carte, you will have a lot of demand uncertainties. So the data indicates that push production also involves a guessing game. Accurately forecasting demand is considered difficult, and the incorrect forecast can result in either insufficient food, so if the guest orders something you don't have it becomes a concern, or you can have excessive food wastage where you stock up on a lot of raw materials, whereas that is not being consumed. So full production is fairly straightforward because you know what type of food and what quantity of food to source. So the head chef is a creator, is a memory, and he's a processor. He plays a very crucial role. He's involved right from the product procurement, development, production, and the extent of the head chef's influence in the supply chain is very, very critical. Depends on the configurations of hotels service supply chain also, which is again shaped by the hotel's characteristics. So they are a valuable resource of expertise and knowledge, the smooth operation of the production plant, which is the kitchen, and all the related activities. So they are creators, memory keepers, processors who oversee production. They're also responsible for key management areas beyond production, such as purchasing and inventory management. Very, very important, because they will only know, they'll only guess how much of food might be required and how do we purchase, how do we manage inventory. So that becomes very key. Are there items which can be substituted? So these are also aspects that only the head chef will have visibility on. The role as a creator stems from the responsibility of writing menu. So menu writing is also very, very important, because it is very, very intuitive. Some concepts emerged from the data that characterize the product development process. Menu not only serve as product offerings, but also functions as a tool to achieve gross profit. So chef consider writing this as more than a job requirement. They think about it as a creative task. Menus are very, very often changed. Many could be changed because, there could be a different demand. It could be a viral item that chefs want to introduce, or it could be because, you are feeling that your pricing is overpriced or underpriced. You want to revise menu rates. You see that one particular item alone keeps getting repeatedly ordered because, say, they're very high or low cost. Then you will have to change it. Or you can also have, say, a restaurant rebranding that was done, or a renovation that was done, where you will have to change the menu according to the ambience. So in all these cases, you will have a menu rebranding. So it is not a fixed cycle. It depends on the chef's judgment. Another critical management area is inventory management, which is a guessing game, because the head chef's knowledge and experience are crucial for managing the supply chain, the supply. And the head chef is a person who holds all this information regarding inventory management. And some hotels will try to have something known as a minimum stock or a reserve stock, where they will say, if my example, a particular type of liquor goes below a particular threshold, I will reorder it, I will replenish it. This is something that will always, keep being consumed. So they will have reserve stocks, or some will have a run out and replace strategy. So hotels that offer food service around the clock, such as restaurants or bars, must always have food in stock. If raw materials are unavailable in the market or deliveries are delayed, they need to have some certain amount of food to ensure production continuity. I can't go tell the customer that this is there in the menu, but I'm not able to offer it because it's not available. So that is I'm posting a very sorry figure when I say that. So that should be curtailed. So once the inventory drops to the guest level, the head chef will have to restock it. So while some hotels can afford a lean strategy, which involves running out of stock and ordering more, it's only there in a very few cases, because most choose to maintain minimum stock as most times. So collaboration with suppliers. Suppliers play a very important role, because they use suppliers. There many also you could have, say, maybe a particular branded liquor, for example, which is there in the menu, which will add value, differentiate your offerings from competitors. They also note that traditional arm's length relationship and long-term cooperative relationship with their suppliers very, very critical. Their food service outlets are leveraged with fresh produce. So they have key partnerships, which the selling point is fresh produce. They have also collaborated with local suppliers and producers to offer specialty, high quality ingredients. Sometimes you find that, some type of items are only available in certain type of places. So you have to have relationship with local suppliers also. So to have a very unique offering. So the strong relationship between the chef and the supplier is very, very important. And you will also have to show that you are supporting the local communities. But while lower raw material costs were constantly pursued, mainly for dry goods. So for dry goods, you can get it from for example, maida, you can source from anywhere. But if you have fresh produce, or if you have items which are, for dry goods, yes, you will compare price across multiple suppliers. You will choose the cheapest option. But you will also, for these purposes, you will have a track sheet. You will say, these are the best suppliers for these particular products. This is where I have an advantage to buy the lowest price without compromising on quality. But you will also have to have, specialty vendors who provide specialty products. There, you may not have a price leverage as compared to this. In addition, they also have a two-supplier strategy to ensure that, if one supplier is not able to provide, or he provides bad quality, or if he increases prices, you can go to the next one. The use of technology, the exploitation of information technology is minimal, with a high degree of manual-based supply chain activities. Very important, because this will be discussed in subsequent questions. Pen and paper are the most primary tools which are used for product planning. So they are saying that even when they are not able to predict the push model, they are only using pen and paper. And they use electronic data interchange with the suppliers. However, it's limited to basic operational tasks, just placing orders. They rarely retain the point of sales data, and sharing information is also non-existent. Demand forecasting may be supported by computer programs, but forecasting is a guessing game. So demand forecasting, though it may be so, I mean, I can say that, I have 20 guests who are coming in. What are the demand? Say 20 guests coming in. I won't know what those 20 guests will order. So that is a demand variant. While I can guess the demand with some extent with the help of computer programs, the demand variant, what will these 20 guests order, is a guessing game. Additionally, stock checking for raw materials is manually performed by physically counting inventory items. While larger hotels utilize online ordering channels, most rely on telephonic communications for placing orders. So widespread use of telephone ordering is attributed to shorter ordering time. So I can just call somebody and say, can you just send me 10 kgs of maida? They will be able to send it. So suppliers lead time is also very, very critical in these aspects. And the fact that telephony opposite two-way communication to say, do you have it? Can you send it to me? So there's also two-way communication. That's why they rely on telephonic exchanges. Even though some hotels employ computer-generated demand forecasting, it only helps the overall volume of food that may be required. Uncertainty on the demand of restaurant food is depending on the variation in food requirements, which is what we discussed earlier. In-house activities. So in-house production facilities offer benefits, but they also require significant investments. For example, if I choose to have a bakery in-house, I need to have very, very specialized equipment. I need to have some chillers, some freezers. There's some very specific equipments that I also have to have, which will involve a lot of capex cost, infrastructure cost. I will also have to have people who, I have pastry chefs who I have on roll, regardless of whether or not there is a requirement. So it's a very captive model. It is easy to implement customized products for specific customer requirements. The company is less reliant on external suppliers and manufacturers, which will reduce the risk on my supply chain disruptions. But actually, the company uses in-house team of highly trained staff for food preparation, which is a time and labor-intensive process. However, the rising cost and increasing cost of food items are putting pressures on margins. So they're saying, while I can have it, it is capital intensive, but it will reduce my risk that, there could be a potential supply chain disruption in the future. But however, I also have to look at my cost, because costs are also increasing steadily. Margins are being affected. So this is why the APC and the cost per cover, all these come into play. These are the metrics that they will use to see how are my margins being played out, how are my price per covers in different restaurants. They could have a specialty restaurant, say something that's only doing Chinese cuisine. I could have only an Italian cuisine restaurant. I would have a multi-cuisine restaurant which caters to everything. I could have a pastry shop. So I could have different restaurants. I could also see how each of these restaurants are doing. Where is my cost very high? So where should I revise? Where should I reduce my cost? Where should I revise my menu to make the price a little higher? So that is where the metrics come into play. So during audit planning, the auditor was informed that the entity generates. Oh, sorry. I didn't read this. So several years ago, they appointed Mr. Ramakrishnan as a company secretary, and he was promised annual salary hike of 15 to 25% depending on a CTC, and he has been performing exceptionally, exceeding expectations, and he's been instrumental in managing regulatory challenges. During the audit planning, the auditor was informed that the company generates a substantial portion of the revenue through cash sales. Very, very important that the substantial is through cash sales. Annual revenues of 1,000 crores. Key management personnel and senior management often face intense pressure to meet or exceed financial targets set by investors and analysts. Remuneration is based on achieving these performance targets. Very, very important that we already discussed that customer satisfaction code could be factor in their performance appraisals. This could also be a very important aspect. So percent of their performance bonus could only be paid if they are meeting these targets. So there it's a very key risk factor, which we will discuss below. So the internal auditor assessed the internal control system and did not observe any deficiencies in the revenue recognition process. And based on the assessment, the auditor concluded that the revenue is not susceptible to fraud risk. Accordingly, there is no fraud risk in revenues, what he says. They have a policy of providing loans at 5% annual rate of interest. The amount to be repaid in 5 equal installments. The market rate is 10%. So on April 1st, an employee took out a loan for 10 lakhs, annual EMI of 2.31. They recognized a financial asset of 10 lakhs and accrued interest at 5%. And receive the EMI payment. This is what they are doing. The auditor raised concern about the accounting treatment adopted by the entity, which we will discuss subsequently. And the auditor also plans to communicate several important. The auditor plans to communicate the audit committee SA 230 for various important SA 260 for various important reasons. To have open communication, to have a culture of transparency, build trust between auditors and those charged with governance, critical to perform their duties without obstruction and governance. For governance and confidence in the audit process. They also have an overseas subsidiary, Black Pearl LLC, under the FEMA. They're supposed to file an APR with the RBI. It's part of the compliance framework. And by adhering to this regulation, open communication of the audits, they foster a culture of transparency, building trust between auditors and those charged with governance. And it's essential for the smooth functioning of the audit process and ensuring your confidence in the financial oversight of the company. This is the information that they've given. So they have also said that they have all these different brands. So King's Corner, which is spacious suites with premium furnishing. They have Focus Focus, which is exclusive, upscale hotels. They have Stories, which is functional, simple. You have some simple functional designs. You have Silver Line, which is wellness centers. This is their brand portfolio. They've also given you the particular information under 197. They've given you, which we will use for one of the questions. So whether the engagement partner, so we'll quickly jump into the questions. Whether the engagement partner is correct in claiming the risk of presumptive risk of revenue recognition. Engagement partner is correct in claiming the presumptive risk of revenue recognition. So no risk of fraud exists in revenue. Remuneration based on achievement of performance targets can incentivize employees to manipulate revenue. Greater risk of fraud exists when substantial portion of revenues are through cash sales. Yes, risk of fraud does not exist since revenue is more than the SEBI prescribed limit of 500 crores. Yes, risk of fraud does not exist in revenue. Performance-based service conditions are common in Indian industries. It does not necessarily lead to a fraud in revenue. Yes, the risk of fraud does not exist in revenue. Performance-based service conditions and concentration of cash sales are common. These conditions do not necessarily lead to a fraud. So we'll quickly go to the answer. So we'll quickly see SA 240. What does SA 240 say? So SA 240 says that while identifying and assessing, the risk of material misstatement due to fraud, the auditor shall, based on a presumption that risks of fraud in revenue recognition, evaluate which types of revenue transactions or assertion give rise to such risks. So they're saying it's a yes, perfect. You're right. You're right. You're right, Sanjay. Perfect. But I'm just explaining why you're right. So yes, just a second. Yes. So they're saying the auditor should conclude that the presumption is not applicable. They should record why the presumption is not applicable, and accordingly why they've not identified revenue risk as the risk of material misstatement due to fraud. So they're saying you have to presume that there's a risk of fraud. If not, you have to specifically rebut why you think that there is no fraud risk as far as revenue is concerned, is what they're saying, right? And then they're also giving you risks of fraud in revenue is especially considered to be high. They could be, it could be higher because there could be pressures and incentives on the management to commit fraudulent reporting activities to inappropriate revenue recognition in case of listed entities. When, for example, performance is measured by revenue growth or profit. So where there's a pressure for somebody, if the management, there's a pressure on the management or the lower level staff to say that you have to achieve a target of last year we did 1,000 crores, this year we have to do 1,100 crores. There's a pressure, then you will have more inaccurate revenues being reported, fictitious revenues being reported, because there's a possibility. So the answer is A, especially because they specifically said somewhere that there was, just a second. So they've said that key managerial person and senior member often face intense pressure to meet or exceed financial targets, remunerations based on achieving these performances. And by reading SA 240, we can say that the risk of fraud exists. And they've also said somewhere that a lot of their sales come through cash. So that also is a very high risk factor, fraud risk factor. Sir, should Sartaj obtain audited financial statements of Black Pearl LLC while filing its APR? What is the most appropriate answer? So filing of APR can be based only on audited financial statements of Black Pearl. Filing of APR can be based only on reviewed financials of Black Pearl. APR should be based on unaudited financial statements since the law of the host country do not provide for mandatory audit, or filing of APR should be based on audited financial statements since Black Pearl is controlled by this company. So what do you think is the answer? Go to the FEMA. So let's go to FEMA regulation, overseas investment regulation 2022. So they've said that the APR shall be based on audited financial statements of the foreign entity, provided where the person resident in India does not control the foreign entity and the laws of the host jurisdiction, as the case may be, do not provide for mandatory audit, and the APR may be submitted based on unaudited financial statements. These conditions are not applicable because the Indian company does have control of Black Pearl LLC. So the answer would be D, 2D. because the exemption is only available if they do not have control and the local laws do not mandate audit. Or because that is not applicable in our case, the answer would be 2D. Right? Now, let's go to the third question. Whether giving of loans is in accordance with the requirements of Companies Act 2013. The company should have obtained special resolution under 185, or company does not cover, section 185 does not cover loans to employees not being directors. Therefore, section 186 permits charging concessional rates of return, strict concessional rates of interest. 185 does not cover loans to employees. 186 does not cover loan to employee director or otherwise, and therefore it's in accordance. The company should have obtained special resolution since they're giving a loan to any person, including employee. They're saying charging of interest concessional is specifically prohibited under 186. Go to the answer. So 185 covers only loans. I have the extract I can show it to you. 185 covers loans only to directors and any person whom the director of the company is interested. Here 185 is not triggered. 185 says that no loan should be provided to a company at a lower rate of interest, at a rate of interest lower than the prevailing 1 year, 3 year, 5 year, 10 year government security closer to the tenor of the loan. Explanation also says that the person does not include an individual who is in employment of the company. Therefore, giving of loan is not covered, is not prohibited by 186. And therefore, the answer would be C. 185 does not cover loans to employees. 186 does not cover loans to employees, and therefore, the answer is C. Right? We'll go to the fourth question. Why has Sartaj opted for different brands such as King's Kroner, Hocus Pocus, Stories, Silver Line in its portfolio? Is it to increase operational efficiency by standardizing service across hotel brands? Is it to solely focus on high-end customers and luxury travelers? Is it to minimize investment in food and hospitality sector? Or is it to target different customer segments by offering a variety of experiences ranging from luxury to budget accommodations? Absolutely, that's right. Sanjay is right. Yes, it is to provide different customer segments by offering a variety. This is something that we already discussed in the earlier segment also, that they don't want to confuse their customers and they want to have a very separate brand segregation, right? And the next one would be, which of the following is not in line with the requirement of section 197 of the Companies Act, read with Rule 5.1 of the Companies Appointment and Remuneration Rules 2014. You can also look at the extract. I'll probably give you 1 minute. It was a very interesting case. So you can tell me what the answer is. Just a second. Show the question. If you want, I can also quickly show you what 197 says. Just a second. 26. Disclosure. This is the disclosure required in the board report. This will help you. You probably look at this and then I'll give you 1 minute. Yep. So we'll go to the solution. Okay. So the number of, so what they're given here is just the number of employees as on 31st March 2025 is given. However, they were only required to give the number of permanent employees. The number of permanent employees and roles the company is only required to be given. They need not give the total number of employees. The percentage increase in the median remuneration of employees is given for, if you see here, they've given the median for the past 6 months, whereas they should have given it for the financial year. This percentage of increase in the median remuneration of employees in the financial year should be given. However, they only seem to have given it for 6 months. So that is something which is wrong. And the next thing that has wrong is they have not disclosed for the company secretary percentage increase. They're only talking about directors and CFO. They have not given it for the CS. They've specifically mentioned above that there's a CS for the company. However, they have not given that, because it says that the percentage increase in the remuneration salary for each of the CFO, the chief executive officer, the company secretary, or the manager should be given. However, they have not missed it. So those are the three things which are not in compliance with the right. Perfect. So that is answer B. Okay. Now, recommend correct accounting treatment, initial and subsequent, as per India's 109 of the loans given to employees at the concessional rate. And again, very interesting question. So, if you want me to, I can show you what India's 109 says. Justice. You can have this as a reference. And then you can take 2 minutes and we can just put the answer together. Okay. So B5.1 says the best evidence of the fair value of financial instrument initial recognition is normally the transaction price. If the entity determines the fair value of the initial recognition differs from the transaction price, then it shall account for the instrument as follows. At the measurement required by paragraph 1.5, if the fair value evidenced by quoted price in the active market for an identical asset or liability, or based on a valuation technique that uses only data from observable markets, entity shall recognize the difference as a gain or loss. In all of the cases, it's adjusted to defer the difference in the transaction price. They should recognize the deferred liability as a gain or loss only to the extent that arises from a change in factor that market participants would take into account to and pricing the asset of the liability. So it's very, let's just quickly open the working also. So based on this, the initial recognition of the asset should be at fair value. So if you look at the cash flows, they're saying 2.31 lakhs the cash flow for the 5-year period. So at present value factor of 5%, the total present value would be 10 lakhs. So this is why they're charging 2.31 as the EMI. However, they're also given that the rate in the market rate would be 10% in the market. So if you discount it at 10%, then the present value is only coming to 8.76. So what you will have to do is you will have to recognize it at the transaction as at the present transaction price of 8.76, and the difference will go to your prepaid staff expenses. I'll show you. So the initial recognition would be a financial asset at fair value of 8.76. The fair value of the transaction price would be 8.76 and prepaid staff expense would be 1.24 lakh. And subsequently, what you will do is 8.76. Eventually, you will keep recognizing interest at 10% till the completion of the loan. And then the prepaid staff expenses will be amortized over the tenure of the loan. So this you will straight line and charge off. And then this you will create as a, this will be over the tenure of the loan. And this again will be tenure of the loan at 10%. So 8.76 at 10% would be 10 lakhs at the end of the first period. And including interest, and then for that 10 lakhs will be paid. Right? Okay. Now we go there. Just again, evaluate the supply chain of Sartaj and find the current weakness and recommend recommendations to overcome the same. So we will also go through this quickly. So currently, it's very clear that they themselves are given that the technology adoption is low, the demand forecasting is being done manually. So demand forecasting and knowledge reliance on head chefs. Supply chain is heavily reliant on the head chef for demand forecasting. They said even though they can determine the number of customers, they cannot determine the demand variant. Therefore, that also poses a significant risk, especially with respect to product variance and business volume, which is not data-driven, but it's based on the chef's common sense and guesses based on the business cycle, location, clients. So due to the lack of formal data tracking, there's an absence of historical trends or customer usage information, which can be used as a base for future forecasting. So they don't have the repository of information in order to enable them to forecast it in the system. So that is the inherent weakness. The high job mobility of head chefs and the knowledge retention issues. We tend to change around frequently, so you will lose people who have the operational knowledge, and this information is stored in their head. So when the head chef leaves, the information is also completely left, and the new head chef comes, we again start from square one. So this is extremely inefficient. So there's trial and error. You have to look at inventory requirements based on trial and error. There'll be inconsistencies or inefficiencies in food production. That's also a key weakness. The low technology adoption, they also mentioned that there's very low technology usage in production planning and overall supply chain processes, because they only call people and tell them. Demand forecasting is also a guessing game. It's very less of AML technologies in order to enable them to forecast how demand variance would look through. So manual inventory checks are also a process which they are doing. They're not having stickers or labels. They're not barcodes, nothing like that. They're counting it manually, which is also prone to inefficiencies. There's very time-consuming and costly in-house food production, because we discussed that it's very captive. You have to have specialized equipment. You have to have staff who are always available. You also have high labor costs, fluctuating raw material prices, which put pressure on your margins and overall cost. Right. So, what are the recommendations to overcome these challenges? So, you have a data-driven forecasting. Have a data-driven approach for demand forecasting, which can be based on collecting and storing information of past product offerings, past sales history, past customer service preferences. What are the inventory levels of the hotel at each of these stages? So you can use a data-backed decision-making tool based on this. By analyzing historical trends and customer demand patterns, they can align the inventory management practices also with the actual demand, which can help reduce food wastages, or also help reduce stockouts. Right? Improve knowledge retention, where they should have head chefs formalizing the knowledge that they have. So including their approach to menu development. So how do you develop menu? How do you manage inventory? How do you manage customer preferences? This is something the new chef will have to know when he's being appointed. So they can build on the previous knowledge of the head chef rather than starting from scratch. So there should be a standard documentation on how is the food supply chain practices, how the customer preferences, how is the sales data being used. So that is something that they should do to improve the knowledge retention. Supply chain processes, you start adopting more and more technology, digitize the supply chain process, have integrated platform for sharing data between suppliers. I expect this particular demand today. Would you have in this particular month? Would you have stock for it? This will also help them to order online. They will also have real-time inventory supply of the suppliers. Also know. So if I want so many kgs of cheese, I will know whether the supplier has it or not. So it will also help them in automated demand forecasting. They also can share data with suppliers, which can reduce your lead time, ensure better coordination. Supplier can also know that you will be replenishing your stock in the next so many days based on your demand pattern. So this will also have a jointly managed inventory system to reduce the overall cost of inventory management throughout the entire supply chain, including the supplier's supply chain. So transition to digital tools, menu planning and ordering will streamline operations. They'll be able to focus on the creative role rather than the administrative tasks. Outsourcing is also an option that they can look at, particularly for high value standardized items such as breads. So in a lot of hotels, breads are outsourced to somebody else. So because very regular thing, every day morning and breakfast they keep breads. They know that if every soup order they're not to keep it. So these are very standardized items. frozen foods, for example, desserts, for example. So these are outsourced. They can reduce the in-house labor cost. They can reduce, having manpower and equipments in creating very distinctive, high quality dining experience. They can invest more in that instead of having, all these spending time on regular items. By outsourcing, they can reduce costs also. They can also improve efficiency. They can enhance the unique elements in their menu that differentiates their brand. The next item would be supplier collaboration and dual sourcing. This is something that they are also, we also discussed in the case study. Dual sourcing should continue to be employed as they will help them to manage the supplier risks. So if a supplier is not meeting the quality, they can shift. If the supplier suddenly increases the price, they can shift. So both on quality and cost efficiency, this will be an ideal solution. And also they can have a more collaborative partnership by integrating their expertise in menu development, allowing for joint planning of inventory, which will strengthen the supply chain and add to the hotel's value strengths. The increase efficiency with outsourced or hybrid models. So they could have in-house plus a hybrid model. So this is a in-house production for signature item, outsourced standardized offerings. So breads could be outsourced, whereas all other items and the pastas and pizzas could be in-house. This will allow for efficiency in operations while maintaining the brand's focus for delivering unique customer experiences. So bulk food preparations can also be outsourced, which can free up the resources time, allowing them. But again, we discussed what are the risks of outsourcing in the earlier segment, where Comfort Hotel chooses to keep Homeland Comfort chooses to keep their outsourcing in-house for various different reasons, to address various different risks that we said. So their supply chain has significant potential for improvement, especially in leveraging data for demand forecasting, use of technology, optimizing through outsourcing. By addressing this, they can increase the supply chain, reduce operational cost, and deliver high quality service. So what they've said. Okay, so let's go to an additional question we can discuss, and then after that we can also go and see how we can discuss Karu and how, especially in hospitality sector, what are the key elements that you will have to look as far as Karu is concerned. So this good question would be, for example, this could be Homeland. Homeland operates several hotels and they operate several hotels and resorts across India. It constitutes a significant portion of its total income. The company uses integrated hotel management software that links the front desk, housekeeping, and accounting modules. As part of the audit of revenue, you've been asked to review internal controls over room revenue of Homeland. So you will have to identify what are the key risks associated with room revenue. What are the internal control procedures that should be in place to ensure completeness, accuracy, and validity of room revenue. And you should also suggest audit procedures that can be performed to evaluate the effectiveness of these controls. So I'll probably give you 2 minutes to think through, and then we can discuss around 8:30 minutes. So the key risks would be revenue leakages or unrecorded sales. So it could be a case that the room has been occupied, but it's not been recorded in the system. So you may not have billed it. It could be a manual override, it could be a system override, or it could even be a case where, the front desk officer tells the customer, what, pay me in cash, I'll give you the room. And he doesn't even record it in the system. So especially this is very critical in a company in a hotel where there could be a lot of cash sales. You could have this risk of room being occupied, but it's not being recorded in the system. So that is a very so unrecorded sales or revenue leakage issues. So that is unrecorded revenue itself. And the next could be that it could be recorded, but could be recorded at incorrect rate. So you could have maybe incorrect room tariff application. So a lot of companies choose to have some contracted rates with hotels. For example, banks, HSBC, Standard Chartered, HDFC, all these will have contracted rates with various different hotels. So the rate code there could be, SEB1, for example, where they will have some published tariff corporate contracted rates. But instead of applying this rate, they could have applied a different rate, which could be lower, which could result in revenue leakage, revenue loss, or, it could be a point where there's some dispute in the future. So that is incorrect room application. The next is cutoff errors. So rooms revenue is recorded in incorrect period. So there's early or deferred room revenue recognition. This especially comes in when guests are staying. So, for example, there could be a guest who checks in on 27th of March, 27, 28, 29, 30, 31, and another 5 days. He's going to stay for another 10 and totally 10 days. So April 5th, he's going to check out. So 5 days he was in this financial year, and 5 days outside the financial year. So how do you record such revenues? So those cutoff errors could also be very, very critical. And also improper discounts or complementary rooms. So unauthorized discounts, which the front officer has given, saying, where the best available room rate is 7,000, but they have given the room at, say, 6,000. It could also be unauthorized discounts. It could also be cases where early check-ins or late checkouts were waived. Early check-in should be charged, late checkout should be charged. And there could be cases where those were waived. So these are the key risks that you have essentially in room revenue. Right. And now, what are the key internal controls that need to be implemented? So when you look at booking and reservation controls, all bookings will have to be through a property management software. Property management software will have the list of what are the rooms. And if the rooms are to be activated, there has to be a key card which has to be given. So that can be a systemized centralized property management system where all room bookings go through. Right. So this will serve this end. If you see the PMS records, you will have proof as to whether the room is occupied or not. So this will ensure that, you'll be able to see, is the room occupied or not? If it's occupied but not billed, you will be able to see why it is not billed. And then you should also have segregation of duties between the reservations, billing, and cash receipt. The reservation should be separate, because if I'm the one who's doing a reservation, I'm also one who's collecting cash, then there'll be a SOD conflict, right? So there should be a clear segregation of duties between these stuff. The person who's making the reservation should not be the person who's also collecting the bill. So essentially what it means is the person who's making the reservation will tell the customer, you know what, I'll give you a discount of 1,000 rupees, but you pay me in cash. And they could choose not to show this revenue in the company's records. So that's why you need to have a clear segregation of duty. Okay, revenue leakage could be, so what you can also do is housekeeping staff will be visiting the rooms every day, at least 2 times, especially in star hotels, multiple times. At least twice a day, they will be visiting the rooms to see, do you need any housekeeping services? Do you need to change linens, etc. So there they'll note down how many people are staying in the room. Okay, if the room is occupied or not. So they'll have a log saying, yes, I cleaned this room, 2 people were staying. And if you compare it with the PMS records, you see, there are no people staying in this room today. As per my revenue log, there is nobody who's supposed to stay in the room today. Why is there a difference? So there's always a housekeeping discrepancy report that's being used. That is a very important control aspect as far as revenue is concerned. They will keep that log to ensure that there are no revenues rooms that are missed out to be billed. There could also be cases where there are 3 people sharing a room, but only 2 people have been billed. So extra bed has not been billed. There also you will be able to find out through the housekeeping report, because the housekeeping report will say 3 people, whereas your revenue records will say 2 people. So there also they will be able to know that there is some kind of revenue leakage or discrepancy, and will be able to flag it. So that is a very important control aspect. And also, what is the approval for early check-in or late check-out? So you will have a delegation of authority matrix, where you would say a front office manager is authorized to waive up to 2 hours. The front office manager, and apart from that, the GM is only authorized to approve anything 2 hours and above. Could be something that is there. There is a DOA. So you will also see whether those approvals are in line. Right. And then you will also see rate, so tariff and room control. So you will have some discounts being given, some room rate reductions being given, some special rates being given, some holiday discounts, that being given. So for all that, you will have to take the rate variance report and see what is the rate that I should bill. As per the tariff, what is my rate? As per my best available room, what is the rate? What is the rate that I've actually billed to the customer, and why is there a difference, and who was authorized? Why is there a difference? That has also become a very, very key and control. The rate variances reports are reviewed regularly every day by the hotel management to see whether any instances of revenue leakage. And the recording and cutoff night audit report is being done to reconcile. So there'll be an automatic interface from your property management software or your point of sale software to your ERP. So that interface controls are being checked, and also there's a night audit that is done there. They check everything. They take a lot of exception reports to see, every hotel does this. I mean, every major hotel does this. They will see whether it's a rate variance report signed off, is the housekeeping discrepancy report signed off. Similarly, they will do some controls over, of course, other aspects also. They will see are discounts authorized, are early check-in, late checkout, all those things authorized, are discounts authorized. So there's a night auditor who does this function independently. They will also review your property management software, your point of sale software, the ERP. They will also reconcile this and ensure that there's nothing that is missed out. So that is how cutoff is being ensured. And you will also have some monitoring control. So the finance controller or GM every day will come and see what's the daily occupancy, what's the revenue variance report. So these could be some ongoing monitoring controls they could have. They could also have some surprise audits or exception reports for voids, discounts. So voids is also a very interesting chapter. So a very interesting concept. So they could prepare a bill in a restaurant and suddenly the customer could cancel it. So I have to create a void bill. So how are those voids? Is there a mapping between a kitchen order ticket and actual billing? So these are also things that you could map and see to see that revenue. Of course, it's not as far as room revenue is concerned, but this could be as far as F&B revenue is concerned. So any discounts, any complimentary stays are given. Who has authorized these complimentary stays? Who has authorized these discounts? Could also be some monitoring controls that could be reviewing on a regular basis. So what are the audit procedures that will do to evaluate control effectiveness? You will test the controls. Oh, what are the discounts around discount approvals? So can I take, so you'll take 25 days to see whether, 25 days, all the discounts are being approved. So who has approved it? What's the reason for approval? So this is something that you will do. Could be rate testing. So you'll compare the room tariff with the approved rates and the contract rates. You could take some contract copies and take all the contracts built to all the rooms stayed by, for example, SCB, and see whether the rates are matching. You could do some cutoff testing. You could see last 3 days versus the first 3 days to ensure completeness. And also you will have something called a guest ledger or a stay on guest ledger or whatever the name it's called. So basically what it means is people are staying in. For example, a guest who checked in on 27th of March and is checking out on 5th of April. How do I recognize this revenue? So you have to ensure that 5 days worth of revenue is being recognized. So that will cannot be billed to the customer. That is not yet invoiced to the customer, right? Because you will only raise an invoice at the time of checkout. So in those cases, you will have to review to see that it is parked in a particular debtors control account. You will also have to review that debtor control account to see that there's no overlong pending things that are there, fictitious revenue which is being recorded there. So that is also something that you have to see as far as fictitious revenue fraud aspect is concerned. And compare. So you will also do an analytical review. We discuss a lot of metrics. You will see the ARR, FR. You will look at occupancy rates. You will compare it with industry averages. You will compare it with peer hotels. You will compare it with across months. You will compare it with the previous periods to see whether the same thing is made, if seasonality is an important factor in that particular hotel. So this is what you do as far as analytical reviews concerned. So strong internal controls over the front desk, authorized list of rates and reconciliation is very important to ensure that room revenue is recorded completely and accurately. So weaknesses can affect both profitability and audit assumptions in the complete and occurrence of revenue. Right? Can you do something similar for capitalization? So if you're looking at project capitalization, can you think for 2 minutes to see what are all the key risks over project capitalization? Because we discussed that one of the other major risks in hotels would be project capitalization, which is basically capitalization. So can you just think through for a minute, and then we will discuss what are the controls and what are the procedures that you could do. It's just an extension of this. Okay, so you will somebody's telling me. Absolutely, you have to check the assertions. Absolutely, that's right. But I'm talking about absolutely, you're right. So essentially, everything that you do will be centered on these assertions. But what I'm trying to say is, what are the key risks that you could have? You're absolutely right. But there are some very specific risks as far as capitalization is concerned. So some key risks could be that there could be an unauthorized purchase of fixed assets. So according to project capitalization, an assessment of viability of long-term projects is a focus area because there could be significant management judgment if these costs are eligible for capitalization, whether the asset is when is the asset available for use, have I started depreciation and things like that. So few risks and key controls that you could have centered around capitalization or unauthorized purchase of fixed assets. So the control that you would have is all capex proposals will have to be approved by the delegation of authority matrix. Everything will have to be approved. So, example, everything above a couple of say 10 crores will have to be approved by the board. Everything above so much can be approved by CEOs. It could be anything, right? So then you will have the annual budget being allocated for the capital expenditures or projects or renovation. So that's how you will know that there is no unauthorized purchase for fixed assets. And then fixed assets could not be purchased at the optimum price. So for this, companies will try to have controls where at least 3 vendor quotations, or there could be a tender documentation where there's an open tender which is lent. So these controls will be critical to ensure that the fixed assets are procured at the correct price, at the best price which is available to the company. And then there could be incorrect capitalization of assets. Capitalization could be possible that you are the controls that they will have is ensuring that the engineer or the project team certifies and signs off saying that capitalization, the put use date is so and so, or you can look at the date on which the rooms have started to being sold, date on which the first sale has been made from that restaurant or first sale has been made from that room, and then you will know that the room is already available. So if they continue to say no, some painting work is there, this is there, that is there, you would say no, you've already sold the room, so you cannot continue to capitalize costs. So what do we do as part of audit? So we'll test some key controls over the project cycle, such as cost, budget, comparison of the cost with the budget. So what has been approved, what has been what has been approved, what is the actual what is the budget that was approved, what was the actual spend, is there any discrepancy, if there's any discrepancy, is there any reallocation of budget, is subsequent approval required, is it within the budget? So those kind of checks you will do. And then you will also validate costs with a sample basis to the construction contracts, the supplier invoices. So you will ensure that these costs are actually eligible for capitalization. And you will see whether these are eligible. So you will look at the nature of expense to see, are these costs capitalizable or not. We saw a couple of cases, right, that are not eligible for capitalization, like labor strike or the relocation cost, things like that, or the general administrative overhead cost. So those aspects, there's something like that, then only you know based on the substantive testing that these costs are not eligible for capitalization. Will ensure the costs associated with the rooms which are to be let out, which came into production, that you are ceased to be capitalized. This is something again we discussed, that if the rooms are let out, from that day capitalization has to stop. This is also what your index says. You will also have to check whether depreciation and the useful life is in line with the accounting policy or schedule to the Companies Act. This is also something that you check generally. So what is the stage of completion of the renovation project? So are the assets intended going the way that its management is intended? Has it stalled? So there could be projects where I've spent some money and it is going on and nothing is coming to a close. So you'll have to see whether I have to impair that, whether at all the CWIP will be recoverable, long-standing projects, long outstanding projects. Then you will also review the repairs and maintenance GL to ensure that routine repairs and maintenance costs. You will do two things. Routine repairs will have to be charged off, and you will have to also ensure that no major item is there in the repairs and maintenance GL. Both ways you will check, right? So anything that does not end, so when you're verifying, so if you find something, some repair cost which is being shown as as cost populist, you will move it to RNMGL. But you will also review the RNMGL, the person maintenance GL, to ensure that there is no cost that is been expensed of which is supposed to be capitalized. So two-way check you will do. And also ensure that if an asset has no longer, so example, I've demolished a building, the demolished building has to go away from books. So that decapitalization has to be done. It's not just necessary if I capitalize a new asset there in my gross block. So there also you learn to ensure that the amount is written off and closed out. Right? So this was something that I thought I'd discuss with you. And then the last item that I wanted to discuss with you today was on Caro. So that I just took the example of, say, IHCL, which is again a company in the hospitality space, a very famous company. And I just thought we can discuss a couple of areas where, in Caro, hospitality, as far as hospitality companies are concerned, they could be an item that you will have to keep in mind when you're doing the audit. So the first is the company has maintained proper records showing full particulars, including the details and the situation of PP. It's very, very important because you have to ensure that the FAR is complete, especially because the FAR will be very, very material. They should have details of where is the asset used. You can't just say this is there in the Delhi property. It has to say Delhi, it is there in the spa, it is there in the kitchen, it is there in the banquets, it's there in this. So you have to ensure that the location information, to the extent that will help you identify the asset when you're doing a physical verification, that level of information is captured. It is not just sufficient if it says this particular wooden table is there in Delhi. It should say it is there in the spa room. It is there in the banquet room. It is there in the this particular conference room. So it should have that level of information. This is especially critical because the number of assets in that hotel is very, very high. And it's virtually impossible when you do a physical verification if that level of information is not available. Some companies choose to do a capitalization floor-wise. Some companies choose to do it room-wise. So the more details, the better. But it should be sufficient for you to undertake your physical verification. So at least that level of information should be available. So intangible assets, similarly, they should have full details. So they should have this physical verification program again becomes very, very key because they could be, especially if assets are capitalized in earlier years, you will have 10 tables together and you don't know where those 10 tables are. So what do I do with those 10 tables? Do I write it off? How do I provide for it? So what is the physical verification program that I have? How often do I physically verify? Is that adequate compared to the size? So periodicity, is it reasonable? Companies can't say I will review it once in 10 years. Especially if the asset if the fixed asset in the company is very, very significant. So you'll have to ensure that the periodicity of physical verification is also reasonable when compared to the nature and size of the operations. So are there any material discrepancies that you identify? And does that have a bearing on the internal control of the company? It's also something that you will see. And the next aspect you will see is this again becomes very, 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 very critical because you will have a lot of companies which are amalgamated, hotels which are brought over by the company. We saw that the company was trying to buy over a property from Goa. So the PATA, the other title deed documents will be in the name of the erstwhile company. You have to ensure that those are mutated in the name of this company. That becomes very, very critical. So because there are a lot of acquisition as far as hotels are concerned, this is something that you will have to see whether the title deeds and the lease deed also. So there can also be lease deeds where you have taken an item on lease. However, the lease deed is not in your name for so many reasons. You have constructed a property, or the lease you have constructed a property and the lease period is less than the useful life of that building. So those could be very, very critical aspects when you are auditing hotels. So please keep that in mind, right? And then, so this company also seems to have a case where, lease expired in 2000, company has filed a writ petition for renewal of lease, and they could have some fixed assets relating to this particular leased land. There again becomes critical. Of course, revaluation and Benami property are regular, nothing very different from other companies. Inventory again becomes very, very critical because they could have different types of inventory. You could have provisions, you could have food and liquor stock, you could have meat, fish, poultry stock, you could have operating supplies like linen, cutlery, crockery. So you could have this concept of circulating and non-circulating stock, which we discussed. So all these become very critical on how I'm planning the fixed asset verification of all these items. And how do I ensure that there are no material discrepancies? We'll also have to see, because Caro says based on class of inventories. What am I considering as a class of inventory? Is also something that becomes very, very important. And also, have I hypothecated this inventory to get working capital loan, which will come below? So whether they've been sanctioned working capital limits more than 5 crores based on these inventory items, and if I take my trial balance and my stock in hand report and I compare it with the quarterly declarations, are they matching? If they don't match, then you will again have to flag it as per this particular clause of Caro. So that is also something, a very discrepancy that you've noted. Especially we also saw that, a lot of manual verification is there in because the number of items are very, very high. So hotel physical verifications usually take a long time. Sometimes it's even done over a period of 3 days. So how do you as an auditor get assurance that, physical verification process is adequate, whether there has been no material discrepancy identified? That becomes key. Loans and advances, there's nothing nothing that stands out as far as hospitality is concerned. Just a second. Very, very difficult to navigate. So you could have a lot of, again, 185, 186 compliance, nothing much. Deposits, again, nothing much. Cost records, nothing much, because service company, cost records may not be applicable. Maintenance of cost records. And so, as far as contingent liability and your contingent liability items are concerned, hotels usually will have a lot of cases relating to the 12 VAT regime. They could have some issues with excise, could have some luxury tax cases. So, these are the things that you have to keep in mind. What is the nature? So, you also, of course, VAT and CGST, income tax, things like that you will have. Yes, entertainment tax, sales and value added tax. You will have property tax cases. A lot of property taxes cases could be there. So these are things that you keep your eyes open for, land tax and things like that. And 8, 9, oh, nothing much. Just a second, I'll go to the next one. IPOs, again, could be case specific. Frauds. So he will always find that hotel companies invariably some kind of fraud will always be there. So the car also prescribes some thresholds for materiality. So what does it say? What's your materiality threshold? How have you addressed it? So that also becomes very key when you are reporting on this particular section on frauds. Then apart from that, I don't think there's anything very particular when compared to other industries. So if you have any questions, you can let me know. These are only a few things that I want to share with you, especially on the title deeds and stop sharing. So these are some of the key aspects that I wanted to discuss with you today. And if you have any questions, feel free to reach out to me. I hope the session has been productive. You can, yeah. So over to Mr. Deepak.
On behalf of everyone here, I would like to sincerely thank CA Sujana ma'am for taking out of her busy time to be with us today. We truly appreciate the way you explain how the tax laws, financial reporting regulation, and business strategy are all linked together when a company wants to grow in a responsible way. Your examples made it clear that business decisions are not about one subject alone, but about looking a bigger picture, a holistic approach. That is exactly what is the integrated business solution paper is. It teaches us how to connect different subjects, how to take strategic decision, and all different subjects are interconnected with each other. Ma'am, your insights have given us clarity and confidence, and we are grateful for your guidance. Students, now it's your time. Please go ahead and ask your query. General query if you have any query. In my chat box, there is a query how to prepare the IBS exam for coming attempt. Student, I always say it is very important to think strategically. If you go with proper planning and proper strategy, I am sure you will 100% clear this exam. Not only clear, but you will get more than 60 marks in an easy manner. Okay. Now I am guiding you step by step strategy. It will really help you in your preparation. Okay. First of all, you have to start your preparation by revising fundamental concepts, fundamental concepts from your core subjects like financial reporting, taxation, auditing. Okay, but at the same time, don't ignore self-paced module set A and set B. Both are equally important. In examination, currently around 15 to 20 marks questions are being asked from self-paced module A or self-paced module B. Therefore, focus on strategic models like Porter's five forces, SWOT, value chain. Because why I am saying this? Because this is multidisciplinary case study with strategic management. Therefore, they may ask questions based on strategic models. Therefore, because doing strategic models are very easy, it is very easy, but you should have at least basic understanding of these models. Okay, first focus on strategic models. Now, know how legal provisions are applied. From law perspective, corporate governance portion is very important, like director appointment, resignation, or director setting fees, etc. SEBI LODR regulations are very important in case of listed company. These come up often in case studies involving disclosures, okay, board board structure or compliances. From AFM Forex concepts. Forex concepts can be easily connected in any case study. When I am discussing about Forex concept, then it can also be connected with FEMA. FEMA regulations are must know for companies operating in or dealing in the international jurisdictions. Okay, now practice. Board of Studies has provided enough multidisciplinary case studies through its portal. Therefore, do practice, practice and practice. You may find case studies in Case Study Digest, Students Journal, Revision Test Paper, and in mock test paper as well. Currently, there are more than 100 case studies are available, and more than 50% of the case studies are based on real world companies. Okay, this helps you relate your study material concept with actual business scenarios. Now, timeline. By November end, look out new case studies in the RTP. Attempt them without referring. You have to attempt all the case studies without referring the suggested answers. Some of the case studies may be tricky, may be difficult, but these are intentionally designed to prepare you for examination day. If you have good practice or you are able to face typical case study, then in examination you will find the case very easy. Attempt mock test paper in the examination condition. Don't cheat. Okay, this will help you in identifying your weak area. Practice time management, gaining confidence, and importantly, the feedback. Feedback of first mock test paper will help you to improve your score in mock test paper 2, and feedback of mock test paper 2 will also help you in improving your overall position in this paper. Therefore, mock test paper is very, very, very important. Okay, and don't do auditing of questions or case studies. While studying, try to solve each question on your notebook. Some students says to save time, we do auditing of questions. Means they simply tick the solution. Okay, please don't do auditing of questions or solutions or your case studies solutions. Instead, try to solve all questions case studies on your notebook. It will be really helpful for you. Okay, treat every case study like a real business problem. But again, I am saying the conceptual understanding for this paper is must. If you have at least basic conceptual understanding of the concept, you can easily crack this exam. But you should have at least basic conceptual understanding. Without conceptual understanding, you are not able to correlate the concept with your open book resources. Okay, now there is one more query. It is about uh, sir, I have not studied self-page module in detail. What should I do? Set A covers corporate and economic laws. One thing is certain. One thing is 100%, the Companies Act will apply to almost all companies discussed in the case studies. Whether it's a multiple choice question or a descriptive question, you are likely to encounter questions from this area. In today's scenario where corporate failures are increasingly or reported, corporate governance becomes highly relevant. As I told you earlier, kindly make specific focus on corporate governance area from the law portion. SABI LODR, I have already told you. Similarly, FEMA. Overall, you can expect around 15 to 20 marks questions from this portion. And if you have again basic conceptual understanding, your concepts are clear, then you can easily answer. Regarding Set B focus on strategic models like McKinsey 7S, Porter 5 Forces, value chain, etc. Here, create a mind map. Create a mind map of key strategic models, and their application is very, very useful in examination. Everyone know for Porter's 5 forces, there are 5 forces. You must be aware there are 5 forces. But how to apply? If if you have done enough practice, then you can easily apply the Porter's 5 forces or McKinsey 7S or any strategic models very easily. You don't have any need to refer any type of book. Therefore, again, conceptual understanding is must. And don't ignore strategic models. Okay. Uh, there is one more query. It is about what are the books we need to take to examination hall during the IBS examination. Students, feel free to refer any study material you are comfortable with. You are comfortable with just any material. It is advisable to carry the material which is the foundation of your study. It will be very useful. In addition, you may make and carry mind maps or charts to simplify concepts of Companies Act, accounting standards. It will be very useful. In fact, creating your own mind map is very important because the best mind map is the one which is prepared by you. When you make it yourself, your remember flow remains better and know exactly what to find from where during the exam. It helps you to link concepts quickly and apply them under the time of pressure. Remember, the focus of this exam is on application. Okay, so take only those materials that help you to apply what you have already understood. If you have already read the study material, then you can easily able to find and apply the concept in a easy manner. But again, you can apply only when you have read earlier. Students, please ask if you have any other query. Students, please focus on integrated thinking. Instead of memorizing topics in isolation, practice linking concepts from different subjects. Link how a financial decision affects tax implication, regulatory compliances, strategic goals. Work on case studies regularly and evaluate decisions from the CEO's perspective or CFO's perspective. Don't spend too much time on one question. Practice mock test with a timer and get used to reading scenarios quickly. Here, timer is very important. Please check your reading time. Start questions you are confident about and mark others to revisit if time permits. There is one more important thing. Look for what the question truly asks. If question says you to advise, then advise. If says evaluate, evaluate. Evaluate means you have to give proper pros, cons, and then conclusion. If a particular question says some strategic decision, if a question is requiring you to give some strategic advice, whenever you are giving strategic advice, then think from long term perspective. Okay, And always, in any case study, try to finish your answer by giving conclusion, specifically if the question is requiring some strategic decisions. I am not saying it is apply on taxation questions, other questions, but if a question requiring you to give some strategic decision, then you have to finish your answer by giving proper conclusion. Okay, students, please ask. Students, please also practice MCQs. Practice of MCQs are also very important. Okay, you may find multiple options MCQs, most likely, most appropriate, no type of MCQs. Okay, to attempt MCQs, not one important thing. This is elimination rule. If you have good conceptual understanding or basic conceptual understanding, you can easily eliminate incorrect option. First, read scenario. First read MCQ. Try to connect with your given scenario. After correlating these two with your concept, eliminate irrelevant options. Okay, after that you will be easily able to find correct option. Therefore, to attempt MCQs, elimination rule is very important. Again, practice. Practice is very important. There is one query. It is IBS includes many subjects. Do I need to study all topics deeply? Students, not every topic in full deep. Instead, mastering the linkage. Okay, how particular Ind AS affects other decisions, how the impacts, how the taxation impact other decisions. Okay, IBS expects a knowledge understanding with application level. Now I am winding up this session. To all the students who joined today, thank you for your active participation and your questions. Your interest made the session even more meaningful. Keep learning, keep exploring, and most importantly, keep practice. Practice, practice, practice. Wishing you all the best in your preparation. Once again, a big thank you to Sujana ma'am and to everyone for attending this session. Thank you, everyone.